Welcome to another episode of Views from the Top, the ARMA podcast. I'm John Meehan, Head of FinTech and Partner at ARMA. I'm delighted today to be joined by Ambre Soubiran, CEO and founder of Kaiko, the leading provider of regulated data and analytics to the institutional crypto market. Ambre, thank you so much for joining us today.
Thank you.
Let me first set the stage for our audience. The crypto market today sits close to $3 trillion. Spot Bitcoin and Ether ETFs hold over $100 billion in combined institutional assets. BlackRock's Bitcoin ETF alone is now over 50 billion and was one of the most successful ETF launches in history. Tokenized real-world assets, money market funds, treasuries, private credit have crossed over 30 billion in AUM and are growing at triple-digit annual growth rates. The biggest names in finance are all investing heavily in the space. And the full capital market stack, from issuance through to exchange, through to settlement and prime brokerage, is being rebuilt on blockchain rails. And underneath all of this, stablecoins are now settling more than 30 trillion in annual volume. These are truly amazing statistics and really demonstrate the excitement that's around this sector at the moment. And as we see Kaiko, it's very much at the forefront of some of these developments. Ambre, it would be great if you could just, for the audience, just introduce yourself and particularly the vision when you founded the business and how you look at the market.
Yeah, absolutely. So by background, because that explains a little bit the vision, I used to work in a team at HSBC called Strategic Equity Financing, and it was a combination of collateralized lending that were often syndicated deals with multiple banks and equity derivatives, which are quite binary financial instruments. Yet it was a heavily intermediated part of the business. And there was a lot of reconciliation that needed to happen between the banks and then internally between front to middle to back office. So I got into Bitcoin initially just out of pure curiosity. I'm a math graduate and I was reading a math blog. I found the white paper and I went to a Bitcoin meetup on Brick Lane. I was clearly the intruder into a room of crypto anarchists, and I was wearing my HSBC badge. But it got me really interested in what it means to create a digitally native assets that had scarcity, meaning that if I transfer it to you, I don't own it anymore. Yep. And this idea that we had a technology that enabled the representation of a state of the world, timestamps, that would be a decentralized ledger that everybody would reconcile into. So that was what really interested me in the early days of blockchain and Bitcoin. A few years later, when Ethereum launched, I had gone pretty deep into the blockchain Bitcoin rabbit hole. But then when smart contract came into play, I was like, actually, if you can overlay the notion of a distributed single source of truth for the checks and balances of the world, and you can layer on top of that parametric smart contract execution. And if you think about it, a financial contract such as a lending deal that has collateral or an equity derivative, like a put option on a listed equity, is a very binary instrument. It's either there's a margin call or there's no. Either there is a payout or the option expires. So I was like, if we can now transform financial contracts into smart contracts and then run them on a distributed ledger, you can solve a lot of the multi-party coordination difficulties. You can solve a lot of the intermediated execution breaks that we have currently in the system. However, if you believe in a world with disintermediated execution, parametric financial contract execution, the data becomes so critical because you reduce settlement times, you bring on a lot of automation, you really cannot mess up the data. So I became obsessed by, at some point, capital markets are going to leverage a new type of underlying infrastructure. This will likely be a form of blockchain and smart contract logic.
Yeah.
And I want to be the data company that is going to power that world. Now, 10 years ago, that was way too early. Nobody cared. Not a single institution wanted to build a financial application on the blockchain. It was a very kind of crypto industry, crypto retail industry even. And so I said, okay, we still need to pay the bills. Let's start by building a crypto data company. And then we've re-evolved kind of our product line into what it is today, which is finally going back to the original vision.
And as you look at it today, what has been that evolution and how do you see that progressing over the next couple of years?
So to do a quick recap of like the past, I would say Kaiko's 12 years old this year, but let's focus on the last 10 years where a few cycles happened. The first part 10 years ago was crypto native retail investors trading on centralized exchanges. 10 years ago, there was no DeFi, there was no decentralized exchanges. Everything was about trading spot crypto on centralized exchanges such as Kraken or Bitstamp or BitMEX in Hong Kong, etc. So we started by doing market data, which was providing a source of easy access to the global financial activity of all crypto assets across all exchanges. That's how we started. Then crypto derivatives became a thing. We obviously added all of the derivatives data. And then using that market data and that derivatives data, we launched analytics. Analytics, the launch of our analytics business was already a signal that the industry was maturing. It was still very retail, but it was like retail pro arbitrage funds and like starting to have some actual professional approach because it required risk management, liquidity metrics, understanding market microstructure. It was not just your random person who wanted to buy Bitcoin anymore. And that was, I would say, 7-8 years ago. So we had data, then we launched analytics. And it's only a few years later when regulated derivatives and ETPs, and it was the beginning of like the first ETF applications, became a thing that we launched our index business. So today we have a fully owned subsidiary called Kaiko Indices that is regulated under BMR, benchmark regulation, which is a regulatory framework that regulates data providers as soon as they will distribute a data index or benchmark that will be embedded into a regulated financial product. And so here we launched Kaiko Indices when there was the emergence of traditional regulated financial products referencing crypto assets. ETPs in Europe were quite early. The first European ETP, I think, was listed on the Stockholm stock market back in 2014, 2015, but it was relatively low AUMs. But the interesting part was when regulated derivatives became a thing. Like SIBO launched their crypto derivatives quite early on. And so here you basically needed those regulated independent benchmarks to provide data for regulated derivatives. The interesting thing here is because crypto is by nature a 24/7 asset class, our index business was built natively to cater for a 24/7 asset class and for 24/7 markets and products, which became a very strong asset recently when we looked at non-crypto 24/7 data products. But so we launched Kaiko Indices, I think 4 or 5 years ago, really when kind of the growth of ETP and launch of regulated TradFi products became a reality. And it's only over the past 2-3 years that our last business called data infrastructure really started scaling. Data infrastructure is less about the data products, but more about how are we going to service traditional financial applications on the blockchain with TradFi market data. And so this data infrastructure business is more a technical bridge or a technical solution for data owners to service this kind of new world of on-chain capital markets with their data while protecting their IP. The closest thing to our data infra business inside crypto would be the oracles, but we're taking a very, very kind of TradFi regulated approach to data distribution on-chain.
And if you look at that, if you look at the crypto markets today, some people would describe them as unstructured or very messy because there's hundreds of venues, there's no consolidation, tape, etc. What challenges does that give you as a provider?
So you're 100% right. Crypto is very unique in the sense that the same asset, Bitcoin, trades on hundreds of venues, right? Mm-hmm. And so you have huge price fragmentation, price dislocation. I'm talking about price, the same with volumes actually, but specifically with the data angle, you have huge price dislocation. Now, prices are very correlated, and obviously there's like probably, 20% of the exchanges drive 80% of the volume. However, getting access to all of that information in real time to a simple question: what is the price of Bitcoin? What is currently the aggregate market depth of all the bids and asks on Bitcoin against US dollar? Like you need to get the data across a lot of different venues and aggregate that and standardize that and all. So this is actually what the first value we brought to the industry, which is kind of giving transparency and accuracy into the global market for those kind of same assets, which were crypto assets. Now it's interesting because those crypto native markets, like exchanges, are now offering also investors to trade traditional assets. Mm-hmm. So if you just look at Apple, for example, I think Apple trades across a dozen different crypto markets where it's not a great way for you as an investor to purchase the Apple security.
Yeah.
However, it is a great way for you to get a synthetic exposure to the price of the Apple share. So from a data standpoint, what we're seeing is price discovery 24/7 across dozens of exchanges for traditional assets. And this is a kind of interesting evolution that is fragmenting price discovery for assets that initially had just one exchange, which was the official exchange price.
And linked to that, if one thing that fascinates me about particularly crypto is that particularly against other financial data venues, is that the data itself is public. And therefore, you have to create a moat on top of a raw layer, essentially. What does that mean, and how do you actually achieve that?
So I would say there's three moats in the public side of crypto data. One of them is the technology one. It's just doing what we do at scale. To give you a sense, we cover every single tick trade, every bid, every ask for over 2,200,000 instruments in real time globally. So that's just a lot of data. Is a lot. That is just a technical challenge. And honestly, it wouldn't make sense for every company in the world. We have 250 clients today. If they all had to do what we do, it would be a nightmare for everyone. Mm-hmm. So there's a real technological moat in doing that well at scale and delivering that service to the industry. That's one thing. The second one is purely more regulatory. Like we actually have data licensing agreements with the exchanges. We are allowed to do what we do. We're not just kind of scraping the data. Yeah. And so that matters. And that creates another moat, which is actually hard to get, all these exchanges to grant you the right to redistribute their market data. Mm-hmm. And so we're partners with them and we work with exchanges proactively, et cetera. That's another piece. And then the third one is the distribution network. 250 clients in the kind of B2B institutional regulated side of thing is a very big chunk of the industry. And so it kind of also just creates a defensibility that it's hard to replicate the business.
And to that end, for somebody who's outside the industry, why are some of the larger incumbents, the Bloombergs, the S&Ps of this world, even the exchanges themselves, why can't they do this themselves? What is it that differentiates you versus them and enables you to be so successful?
So all of these companies you mentioned are partners and clients of Kaiko, and I think we really work with them, not against them. We've always have. And what they get from us is the blockchain expertise. Mm-hmm. Honestly, I don't think that, especially in the early days, none of them would want or even sometimes would even be able to get approvals to start connecting to all sorts of APIs globally of crypto venues. And let's not forget the other part of the crypto data price formation, which is on-chain. So in order to get data from a decentralized exchange such as Uniswap, which is most of the on-chain DEX volume today, you need to run a node. So you actually need to run blockchain infrastructure. You need to collect events blockchain data in real time. And then you need to almost kind of reverse engineer the protocol in order to extract the data from the blockchain that is related to what you want to do and then turn it into a market data price feed. And so all of that is quite deep blockchain expertise and requires the ability to run blockchain infrastructure. So we've been partnering with them. And actually, I love that you brought those two examples. Bloomberg, we've been working with them for almost 10 years now, initially working on an identifier called FIGI, Financial Instrument Global Identifier, that is like a taxonomy data identifier used in like backend database to identify uniquely financial instruments. We went to them 7 or 8 years ago to tell them we need to expand that identifier scope to include crypto assets.
Yeah.
And we became their partners on doing that, which is really a taxonomy thing. Then they wanted to start bringing on crypto data to the terminal. And so they became clients, and we are powering a lot of the crypto data on the terminal. And over the recent years, when we were like, well, your data could be now valuable on-chain to power traditional financial applications that are even applications that are run by your existing clients, right? So if you're a bank and you want to use the blockchain to do a cash flow calculation for your treasury desk, and you want to be able to consume the same data that you would consume off-chain, very often it's going to be Bloomberg data license. So what we offered to Bloomberg and where we partnered together is we are helping them service their existing licensed clients to consume the Bloomberg data license natively on-chain in smart contract logic workflows. And so that's extremely powerful. And that shows how we've evolved into the relationship by just being a good partner. And they've been fantastic partners with us too, and never being like against them or competing with them. We've been, bringing that kind of blockchain native data and infra expertise. And now they're bringing their data into the blockchain world. S&P is a very similar growth story. We started working with them on ratings because they're consuming some of our data for their stablecoin assessment score reports. And then we started partnering with them on the index side. And they were the first index company we partnered with to bring a tokenized form of one of their flagship benchmarks into the blockchain. And so it's really being that kind of partner bringing blockchain expertise.
And as you look, over the last couple of years, you've made a few acquisitions. Maybe you can just talk us through the rationale for those acquisitions and how you see that building out your overall offering.
Yep. So when you asked earlier about how we've matured our product lines over time, matching kind of the evolution of the industry, M&A was a growth vector for that. So we've been very opportunistic in the build versus buy kind of debates. The first company we ever bought actually was a really amazing company called Kesitis that were building analytics and like risk metrics and implied vol surfaces. They were bringing kind of quant type metrics to crypto markets. We had the data, they had the models, and we started working together as partners because they needed to create those kind of risk data products and they needed the data. And it went so well that we said, okay, we should make that a part of our proposition and integrate you. And you don't have the data, but you have the brains and the models. So come in. And all of the team, and that was our first acquisition 4 years ago. The team, the CEO and the founders of that company are still at Kaiko today.
Right.
So it's been a really good, very collaborative, constructive integration. The second acquisition we did was the first entity for our index business. It was a regulated company under BMR called Napoleon X. We rebranded Kaiko Indices, but that was just a way to accelerate the regulatory framework and then launch our regulated index business. There was no employees, no clients. It was really the shell that we acquired, and then we relaunched the activity for which they were already regulated. Third acquisition was Vinter, was a Swedish company that was the leading provider of indices and benchmark rates for the crypto asset management industry in Europe. And while we had focused all of our benchmark and index distribution on regulated derivatives, it was just a way to acquire a portfolio of about 20 asset managers in Europe. And so this was really just external growth. And that was, we just bought a European ETP position in the crypto world. Finally, the last two acquisitions were done in the past couple of months. One of them is a regulated DeFi engineering company that is regulated as a payment service provider under MiCA CASP. And the reason we acquired them is to provide a regulatory framework for our data infrastructure business in order to enable not just distribution, but also fee collection by data owners on chain. And so that is an acquisition we've done a few months ago. And finally, the last one, and the most meaningful in terms of size, was our last US competitor, Ambre Data. Great business, data and analytics firm, very strong analytics offering, and very, very complementary client base. And so that was announced a couple of weeks ago, and we're very, very happy about that too.
That's great. And how do you manage, on the one hand, the phenomenal growth that you're seeing on the organic side with making acquisitions, integrating those acquisitions, and making sure that both sides work seamlessly together?
I have to give 100% of that credit to every individual at Kaiko. Honestly, like, the team is so incredible. And I say it often, like, I feel like I'm the captain, but like, I'm very, very conscious that I would not be much without the team and the crew. Yeah. And so no, we have an incredible team that I'm extremely proud of. We've been pretty good, I think, at the last M&A was the only sizable one in terms of real like size of the team and the clients. Yeah. So we've really kind of divided and conquered. Like, a part of the organization is laser focused on the integration and doing that kind of quickly and efficiently, while another part of the organization is focused on growth. So that's how we've approached that last acquisition. But yeah, otherwise it's just like really good teamwork.
Congratulations, it's great to see. And if we maybe move on to one of the biggest themes we're seeing at the moment in the crypto world is around tokenization. Yeah. How do you see that today, and how do you see it evolving, and how is Kaiko playing into that team?
This is the most exciting development that I've been praying for, waiting for the past 10 years. And it ties back into the original vision, right? I've done 10 years of banking. I'm still a very TradFi person down to the core. What I find fascinating here is, like, what are the learnings from crypto native infrastructure and products that we can apply to TradFi. And it's, sometimes there's this kind of crypto versus blockchain debates, like crypto bad, blockchain good. Yeah. I think that there is great things in DeFi and crypto that we can learn and apply to TradFi. And that is really happening. We are not just rebuilding existing capital markets onto blockchain infrastructure. We are also changing the way we think about TradFi, leveraging crypto native infrastructure. Yeah. And an example of that is an instrument like the perpetual swap. The perpetual swap is basically a derivatives contract that has no expiry, that was built for crypto because crypto was a 24/7 market with kind of no close of market. And now we are seeing a lot of activity in the non-crypto perpetual swaps. And actually, we've done a lot of creating 24/7 benchmarks to enable the creation of those markets. And so there are equity, perp markets, commodity, fixed income. There was a really interesting recent event when SpaceX IPO'd. The perpetual swap market on crypto native exchanges for SpaceX had priced very accurately the closing price of SpaceX on the day of the IPO. And so here we're seeing a really good example of embedding a traditional asset class into a crypto native financial product that is built on crypto native infrastructure. So super excited to see that happening. It's really like, how do we learn from DeFi and crypto, bring on the privacy, IP, data protection, all of the kind of things that are absolute must-haves in order to have sound financial markets. But how do we kind of find a hybrid version that leverages the strength of both models? And that's happening now. Tokenization is finally moving into a world where it's not just about the representation on-chain of a security. It is about how are we going to embed that security into a workflow that is better on-chain than off-chain. And that is what I'm super interested about, because a couple of years ago, there was a lot of initiatives about, I've issued a tokenized security. A lot of that were like digital twins of old style financial securities. And it didn't have a lot of, on-chain value because the the main asset and the main representation of ownership was off-chain.
Yeah.
Now we are starting to see the emergence of natively issued on-chain securities. The DTCC is launching their natively issued US treasuries. The first test trades are happening in a couple of weeks from now, and then it's going live in production in October. The question is, once you've tokenized those assets, once they live on-chain, what do we do? We get to a state of the world where blockchain technology works, smart contract technology works. You have tokenized securities. You have regulated stablecoins that provide the cash leg. What you need to kind of make all of that work and enable financial applications is data infrastructure.
Yeah.
Because if you're going to use anything, a tokenized asset as collateral into a financial product, you need to be able to continuously price the collateral. And so bridging the world of TradFi market data and on-chain contract execution that will consume those kind of tokenized assets as collateral is critical to enabling kind of the good efficiency of those markets on-chain.
And if you look at that, Larry Fink recently said that tokenization, he thinks, is going to be the next generation of capital markets. Do you concur with that?
100%. And that was my obsession back then, still is today. I remember from our seed deck from 2017 had a chart around tokenization, and I thought that by 2019 we would have tokenized 13 trillion of global wealth. I think it was a little bit ambitious. So, maybe add another 10 years to that. But I think it's like the direction of travel. There's no going back. 100% this is going this way. And then the question is, how do you rebuild market infrastructure on the blockchain infrastructure? And what are the core components of current TradFi market infrastructure? And how do you think about this transition on chain?
And you're across the table from nearly all, if not all, of the large financial institutions. Are they embracing tokenization, or is it still very much a niche that they say they're doing, but not maybe embracing fully?
I think it's both. It's still small, but they're embracing it fully. Like, I really think that those who do not make the move and take this seriously now will be left behind fast. I think the velocity at which the change is happening is going to increase sharply. By the end of this year, we will be in a world where US treasuries are a native available collateral on the blockchain that you can use for a repo, that you can use for your collateral mobility. Like, you can start using this efficiently on chain. From then, I think things accelerate. Whether we're going to see tokenized equities first, whether we're there was an announcement very recently from ICE that they're building their tokenized equities exchange. Like, a lot of things are happening. Most of the TradFi exchanges are partnering with very large crypto exchanges. ICE announced with OKEx, Nasdaq announced with Kraken. Like, it's happening at scale.
But it seems that the US is significantly ahead of Europe here. Do you think that is that true in your opinion? And if so, do you think Europe can catch up or at least be competitive?
It's tough. I mean, Europe, I'm obviously European at heart. We've been very early. We were the first to create ETPs back in 2014, listed financial products enabling people to invest in Bitcoin. And then it took 8 more years or actually 10 more years, I think, for the US to approve the first Bitcoin ETF. So we were early, we're innovative, and we regulated early.
Yeah.
But just the problem is, it's not a problem, it's just the reality is the US has the capital. So when they move big and they move fast. And then we are kind of the cute pioneers. and then they come in and they have just much more, and the US has much more capital. I hope Europe catches up. I really do. But it requires investing.
And you're a very rare company in the fact, as you say, it's European headquartered, yet making or addressing what today is largely a US opportunity.
Yep.
How do you do that, and how have you been successful in crossing the Atlantic?
So indeed, the group Topco company is a French entity, but we have opened our US company, I think it was pre-COVID, 2018, 2019. Like, one of the first things I did, I was in London when I left HSBC and for Kaiko. And so one of the first things I did like 2 years in after we raised our first seed round, which was like $1 million convertible, was to open the US company because I knew that the market and the capital and everything would be there. Today, the large majority of our revenue is from the US market. Mm-hmm. With the Ambre data consolidation, we've really kind of, grown significantly there. So the US has always been the number one market for us. And by design, we had not just like a French company in the US, but we owned a US company, and the entity facing US clients is the US entity. Our headquarters there is in New York. I'm in New York. And so we've just been occupying the space as much as we could. But the G&A, engineering and product is still in France. And I'm very proud of that. Honestly, if we can create a global leader that serves markets, we have a Singaporean entity, a UK entity, like it is a group. Yeah. And I would be very proud to, have the holding company be a French success story.
Well, fingers crossed. And if we look back to late last year in October timeframe, the market went under a lot of stress. Yeah. As you've mentioned, this is a market which is growing very, very rapidly. There will be more volumes. Do you think the infrastructure is there to cope with those increased volumes?
So October 10th was very painful for a lot of people, including some of our clients. So it was, I would say, the way I say every time there's a crypto crisis, mm-hmm. It's like short-term bad, long-term good. Because what happened in October was this kind of huge flash crash of crypto markets. It was horrible. It created cascading liquidations of DeFi lending contracts. And it did have a lot of negative side effects and snowball effects. However, what it highlighted was a structural issue in crypto. One that I've been very painful and vocal about was the importance of good data. Mm-hmm. And crypto, because it's a different ethos, a different mindset, originally a very retail kind of, industry where there is a perception that because data is in the blockchain, it's free. And so you can go and scrape it. And so the truth is, what October 10th highlighted is the importance of the data that you plug into DeFi. And a lot of the contracts that were liquidated because the technology providers of price data for DeFi, which are called oracles, work on a kind of decentralized data distribution. So it creates latency between collecting the price and then bringing the price into the contract. That's mm-hmm. one issue. The way it's designed, and that is very valid, honestly, in the crypto fragmented price dislocation markets that crypto is, which is it would take multiple price from multiple sources, create a VWAP average price, and then provide that into the DeFi environment. The problem of that, beyond adding latency to the data delivery by disintermediating through nodes, is also that you average out the data, meaning that you lose the accountability and the dispute resolution mechanisms that are a core part of how things work when you take a data input to settle a contract. If we agree that we're going to make a bet together on the price of Apple tomorrow, we're going to agree that we're going to look at the 4 p.m. close on NASDAQ, right? Yeah. And if there's a dispute resolution, if we don't agree, there is a contract that says where was the source of the data needed to be taken, et cetera. So October 10th relied on crypto oracles. And the problem is that setup creates no accountability to the price source and delays. And so there were moments where there was a lag between the price that was provided and the consequences of those prices and the prices that were trading on centralized exchanges, for example. And so there was a mismatch in the prices. And then when people started complaining, and there's a lot of blog posts where people complained that their Aave contract got liquidated because the Chainlink Oracle was this and that. And they were like, who do I talk to? Yeah. And there's just no one, right? Yeah. So decentralization is a wonderful thing in many respects. I do think that a data input and a data infrastructure that is going to deliver a critical input into a financial workflow and contract should not be decentralized. That personal opinion here. Yeah. But I really think that you need to protect accountability, timeliness, and IP. Because if you want accountability, somebody needs to own the data to be accountable for it. And so if they're accountable for it, you need to protect their IP because that's how they derive value. I'm accountable for something only if I make money out of this, providing this service, right? So IP, accountability, timeliness are three important features of data in TradFi, and that was not really thought this way for crypto. And that's a big piece of market infrastructure improvements that we are providing to cater for tokenized markets, leveraging crypto native infrastructure.
And if you then look out over the next 5 years, we've discussed how the market is evolving, how quickly it's evolving, and the opportunity that actually exists. Where do you see the market in 5-7 years' time, and how will Kaiko play to those tailwinds that will be in the market?
I really see a world where we are shifting a significant portion of capital markets on the blockchain for use cases such as instant settlement, collateral mobility, repo, all of these kind of capital efficiency financial products. And all of these will require data being continuously fed into those applications on the blockchain. Here, we do not try to disintermediate the owners of data. So we partner with Bloomberg, S&P, and other data owners to provide them with a distribution pipeline for their data. So it is still their data servicing their clients, and we're not disintermediating that. We are a technical partner for the distribution and monetization. And that is the role I hope to be playing at scale in, starting now, but growing into that role, which is really becoming a critical infrastructure partners to all of the data owners who are thinking about how will I service this new kind of on-chain capital markets industry, most of which they're already their existing clients. It's just how do we address them there?
And do you feel very much that you're, in a way, pioneering the market, and because today that doesn't exist, and therefore you're educating, and therefore very much at the forefront of the market?
Yes, I think so. And I think that's what makes it really exciting. It's like finally the whole vision of all these applications will need this layer of infrastructure. And we're learning a lot, by the way, from the crypto native design, the same way that financial service, Broadridge has a decentralized ledger repo platform that is live and that is trading and that is leveraging blockchain technology. They probably learned a lot from other applications that were in DeFi and how they approached it. So we're taking a lot of lessons for how data was thought about for DeFi and crypto, but it's just adding on all of these must-haves from TradFi, and the ability to understand those two worlds within a regulated shell entity company that has been operating at the intersection of those two worlds for 10 years is pretty unique.
Well, thank you so much, Ambre. It's been great to hear the story. Your energy, your enthusiasm is infectious and great to see. And we wish you all the success, and think you're extremely well positioned to take advantage of what is a very, very exciting market.
Thank you so much for having me on the podcast.
Thank you, everybody, for joining today's episode. We hope you enjoyed it, and we very much look forward to welcoming you back for the next episode.